Welcome, investors, to the Alternative Investing Club show. And a happy 2025 to everybody there. We're back with a great lineup of speakers. Here at the Alternative Investing Club, our goal is to provide investor education and opportunities to get into institutional and semi institutional deals. Thank you for being here. Today we have Spencer Hilligoss. Did I get that right? Or
Hilligoss. Close.
Hilligoss. My apologies. Spencer Hilligoss. And we're doing an investor interview. We like to get to know different investors and what they do so that we can further our own education and just to get to know people that are in this community. So, Spencer, welcome to the show.
Daniel, honestly, great to finally meet you. I know we connected online quite a while ago, but this is our first time actually getting to connect this way. So it's a pleasure to be here. Thank you for
It
having me.
sounds like we were both fairly active during the pandemic, as well, 1,000 other podcasts that started, but just a lot of people really kind of got their virtual legs during that time and met around that time as well. Um, I'm glad that actual conferences are coming back, though. It's good to meet in person as well.
Yeah, I mean, it is a person-to-person world, right? And so I think, doing daily posts on LinkedIn for a period of like 3 years, 900 posts in a row or something like that crazy, that was a labor of love, but this is still my preferred way to get to know you.
Absolutely. Well, Spencer, tell us a little about yourself. You can either start with like a backstory if you want, or where you currently work. Just give us like a quick 2 to 3 minute overview.
Yeah, happy to. Well, I'm based here in the Bay Area, California. I currently lead Madison Investing, which is a passive investor club. We like alternatives, a lot of the same asset classes that I think you enjoy as well, Daniel, for your portfolio. Before that, I was in fintech companies and financial tech companies for 13 years. Started out with Intuit, so most people know that because of QuickBooks and TurboTax, et cetera. But I progressively kept going into earlier and earlier stage tech companies because I wanted a challenge. And I mean, anyone out there who's spent any time in an A-series company, VC-funded company knows, then you will find it there. So that was many of the catalyst points that drove me ultimately to want to seek other ways of investing later. But I actually grew up in a real estate household. My dad was a broker for 30 years. He hit the high heights of his career in that business growth in the 90s. And he pulled me in to do open houses as a kid, cleaning out fridges for rentals and properties. And it showed me, frankly, a lot of reasons why I wanted to go into tech. So, I mean, in hindsight, I look back very fondly, and there's so many wonderful reasons that I look back now and, hindsight 2020. And I'm like, deeply grateful for that exposure to the real estate world. But like so many people out there, I mean, like myself, like I thought that meant real estate meant brokerage. I thought real estate only meant single family homes, buying a home eventually. And now, as we know, that is one tiny sliver of the bigger world of investing in hard assets and real estate, or investing in general. It's not just about buying and selling homes. It's like you can go buy a rental property. You can go invest in a medical office. You can go, invest in a fund of self-storage facilities, all these wonderful different things. So that was my earliest exposure to real estate, was dad's business, and also going like, wow, let me go into tech for about 13 years.
Yeah, it's amazing how much our family influences us. And I think it's similar for. Actually, I have kind of a similar backstory. I won't necessarily go into it here, but it was my grandfather that influenced us. He retired as a tractor mechanic from International Harvester, and then only after that, my grandma, who was the real estate genius between the two of them, they decided to buy a 120 unit and they fixed it up in their retirement. And that was why they had something to leave to my parents, the next generation, not because of their job, because they invested after retirement. And
Oh,
that's
cool.
why they were able to leave an inheritance down. So that made an impression on me as a younger kid. Out of curiosity, where are you based in the Bay Area? I grew up in Santa Rosa, so I always have to ask people that.
Oh, no kidding. I actually have a family that still lives in Santa Rosa. So I now live in Alameda, which,
Okay.
yeah, as a guy who grew up in Redwood City over in the peninsula just south of San Francisco, I used to think Alameda was like a drive-by place. Like there was no reason to go
Right.
here, but now we've been living here for over a decade, and it's this little wonderful island pocket right across from like a postcard view of San Francisco next to Oakland.
Are there still nuclear vessels there?
I mean,
Sorry, Star Trek 4 reference for those.
oh,
But
I am that nerdy. But I
oh,
would
okay.
say, well, I do like, it's a quirky place. There's no shortage of like awesome nerd call outs. I mean, also just like the old like naval based presence that we've got out here. Like there's so much cool stuff. Pinball museum. Like it's, yeah, I won't bore people with how great Alameda is because they're like, yeah, whatever, man. I never even heard of
Awesome,
it.
awesome. Oh, I also found out, Brian Burke is another person that's in this industry. He
Mhm.
wrote The Hands-Off Investor. Turns out that my dad and I drove by well, I don't know if he was there at the time, but when I was going to school, where his office was, it was in between our house and our school and my dad's work, and we drove by it almost every single day. And so
No kidding. That's
that was
random.
kind of interesting. I've never met him, but I actually happen to know that in 2018 the office buildings near there burnt down, and so I know exactly where it is.
Wow. That's so random. It's
Yeah,
such a
yeah,
wonderfully small
small world.
world, man.
It is. So tell us, what are you doing now for your investing, and how do you help investors?
Yeah, my goodness, it's been a journey. I know we were chatting it beforehand, and your journey has been has been an experience as well. So these days we focus on just finding great teams, great operators, and investing in them alongside our club members. And it didn't start that way. Of course, I can go into that in a moment. But these days, gosh, it's been a dynamic market to say the least. The
Oh
last
yeah.
2 years, we shifted our focus from we were very focused on multifamily apartments in the South and the Midwest, a little bit of the Rockies, along with self storage. So we've been focused on self storage as well for the past, gosh, 5+ years. And in the last 2 years, we started shifting more toward private credit. So
Hmm.
investing in more in private credit because the banks in the banking industry and financing for a lot of these great assets that I still love, like the demand for multifamily and apartments is still there. So I love investing in those things. Self storage has taken a breath, but like now I just wanted to do a different version of investing that felt like it was one click less risky than investing as equity into some of these deals. And I'm comfortable taking a more conservative, projected potential return on that than a lot of folks who are, a lot of my tech brethren who are still very, very eager to find those angel investment multiples of getting like 25x on their money. Good on them. I'm always happy to celebrate when they do hit one, but I'm comfortable with a much more conservative outcome with a hard asset. so,
Yeah.
I've been leaning more into private credit in the last like year, and so we're excited
When
about
you
that as
say
well.
private credit, are you talking about equity, mezzanine like equity, or
Like
preferred
preferred
equity?
equity. Yeah, like preferred equity and mezzanine, but primarily preferred equity.
Okay, okay. Yeah, there's a great opportunity out there for it right now because there's a certain number of distressed deals. There's a lot of loans that are coming due in the next couple of years and
Right.
have come due. And quite a few operators are not necessarily in the best place because they either had a construction loan or a bridge loan that had a variable interest rate, and that skyrocketed, and so sometimes they've got a good business plan except for they didn't keep their interest rate in check. And but is that is that what you currently focus on right now, or are you focused more on fixed, debt based instruments?
No, I think same asset class, but actually, as opposed to like, I basically took a solid 6 months. This is back at the end of last year, and I was like already leaning into going into more private credit, private debt. We've done. I've personally exited over 20 deals full cycle as as an investor. I've
Congratulations.
invested in stuff beyond real estate, but like right now, the focus has been how do we go find a private credit or debt vehicle where we can still invest on the front end of the deal. Like I still love these assets, so we actually don't focus on as much the rescue, uh,
Okay,
as
okay.
it's branded, like the rescue capital. It's more just the banks are harder to borrow from right now for a lot of
Yeah,
great
yeah, they are.
great teams. So like a great operator wants to go buy an apartment building. I'm like, hey, I like that deal too. Maybe we can just invest into it in a better spot in the capital stack. So that is really the primary focus more so as opposed to the rescue capital. I get a little, just me personally, after I went through that exercise of comparing and stack ranking all these different private debt, private credit funds. There's so many, it's overwhelming. And I got to the
Mhm.
final list, and I was like, you know what? I just think the idea of putting money into fresh acquisitions still sounds a bit more appealing personally, and everyone's investment criteria and thesis is their own. But that's been more appealing to me personally.
Okay. So to flesh that out a little bit, what are your acquisition criteria? Do you look in particular location, I guess, to start?
Yeah, well, and I'll take a step back too and just say, like, I have leaned in more heavily in the recent times to just go heavy on the sponsor. So I'm not necessarily sitting there for our private equity fund that we're doing right now and finding every deal. We have a great operating partner that does that. So they find that, but we spend all the time vetting and finding them. On the actual deal side, though, like, we just closed on a multifamily acquisition, and this is not for private debt. This is for targeting and buying and investing in real estate. We closed on a multifamily deal that was actually a new build. So Midwest, new vintage, so newer building, boring business plan. It's really just like
Boring is beautiful.
but I love boring, and it's, buy the building, economies of scale because you've got one property management company managing multiple assets within a reasonable footprint within that market. And you're not doing a quick turn. I mean, this is like a proper 5-7 year hold period, and it's going to be best kind of boring, not going for a 3x equity multiple. We're just going for like a great, a solid return, being realistic about it, and making sure that we're not blowing the projected returns out of the water. And the reason I bring that up, and the reason it's so key for me right now, is like, if we look at the exits that have actually occurred on some of our portfolio in the past 12, 18 months, there haven't been that many, certainly compared to 2021 and earlier, right? Like,
Sure.
it's a slow market by comparison.
Yeah,
But
for those that can hold it, it's a good time to hold.
yeah, and so those that have exited, though, the best deal that we've exited has been the newest vintage and the lowest conservative projected returns of any deal that we've ever worked on. I'm still blown away by this. Like, best exit we've had in the last 18 months, invested back in 2020. And the numbers were pretty boring. Like, it was a very conservative 7-year hold period. And the business plan was not aggressive for heavy gutted renovation. This is just like topical stuff and the path of progress, which with a building that was within like 12 to 18 months, built when we bought it. So that's the kind of asset now that you're seeing a real flight to safety for, right? Like people like that newer asset. And so that's kind of what we're leaning into on a deal by deal basis. If you look at the real estate side.
Okay. When you're coming in as a preferred equity holder, are you negotiating special terms or special rights? What does that look like?
Yeah, I mean, our partners are,
Right.
but the interesting thing is seeing, you got to have takeover rights.
Yep.
You got to have the ability to do something. I got some insight on this when I was at the fifth tech company that I ended up moving on from in 2019 to go full time and manage our investing club. I was actually working at a lender, and I bring this up because it taught me so much about de-risking as the bank, as it were. And when you're looking at a borrower, you have to underwrite whatever is available. And you also have to ensure that if you need to take over the asset, that you can do that readily. And so that's been a key part of the underwriting criteria and just the term sheet for the fund and the manager that we ended up going into and investing in, a lot of my own capital as well, is they can go second position, maybe sometimes first position, but oftentimes second position, and then be able to have takeover rights on top of it in like a 2 to 3 year term. And so that is a sweet spot, I think. And although some folks like to go for senior positions, some folks like to go to single family funds, some folks like to go for all these different assets. I still love the big commercial real estate asset classes. I still love multifamily, self-storage, industrial, all that stuff. It's in need right now. So I think it's just, why not lean into the obvious opportunity there?
What types of returns are you seeing in preferred equity? Just generalized, I suppose, right now. You don't have to give a specific fund or specific detail, but
Sure.
where are you seeing the market right now in terms of returns?
Yeah, I mean, on the low end, 9%.
Okay.
Probably on the more like what I'm targeting for ours is right now is like somewhere between 13 to 15%.
Yep.
And so it's not going to blow anyone's socks off if they're trying to sit there and compare an epic 22-25% IRR. But
Right.
that's exciting to me for the sake of more liquid.
Hmm.
The lockup periods tend to be only a couple of years as opposed to 5+. You see that the target returns are achievable, uh,
Hmm.
which is great. And so that's more in the striking zone that I'm interested in.
Tell me a little bit more about the shorter time period. I wasn't expecting you to say that actually. Why is it shorter than a typical value add deal?
Yeah, well, I think ultimately it comes down to you're already putting you're investing in, and that capital is being deployed into a deal with a very experienced team, and they're not trying to do the entire loan. They're not doing like this massive amount. You're only doing maybe 1 million, 2 million, $3 million, and so the way it can be structured is that payoff is still achievable within a much faster timetable because you're not paying down $10 to $20 million.
Gotcha. Gotcha. So you're hitting a point where you're, like Robert Kiyosaki would say, that infinite return. Are you staying in the deal after that, or are you out of the deal at that point?
You're out of the deal at that point.
Okay. Okay.
Yeah.
Interesting.
When we first leaned into it, by the way, I think I was not expecting the market to necessarily say interest rates were going to stay as higher for longer as they're appearing to now be. Like I think we were all thinking that the interest rate cuts from the Fed were going to start hitting more aggressively, but they've also flip flopped on that dramatically in the last 12 months. So
Hmm.
now that we're getting into 2025 and everyone's like, oh, wow, I think this is truly going to stay higher for longer. We're feeling very good about the positioning, like really, really good about leaning into this because it's needed, and I don't think the need
Yeah.
is going to be uh, the demand is going to continue for the next couple of years.
Yeah. Yeah. I agree. I think that interest rates are going to be higher for probably a foreseeable future, if you, in my opinion. But as well as some degree of inflation as well. And so being in assets is a good place to be.
Yeah, agreed. And so I think that is one key focus for private credit for us now. The other is I'm still a fan, very much so, of self storage. I think that
Mhm.
is having it's really taken a breath because, I mean, the market is very clearly pronouncing demand for self storage is tied more directly to single family home transactions than anyone ever really understood.
Mm,
At least in the modern times.
interesting.
Yeah, so like people
I,
are not buying and selling homes, and so people are not storing their stuff as
oh,
much.
well, yeah, yeah, that makes sense. That makes perfect sense. I is the self storage market saturated or overbuilt? Are we in that scenario? I mean, I think we are in many communities, but
Yeah, in some markets
as
for
a
sure.
general rule.
Yeah,
Okay.
I think in some markets, absolutely. One of the bigger takeaways from recent times has been like if we look at the exits we had in 2024, we had 5 exits in 2024. One of them was self storage. That was in a tertiary market,
Hmm.
and so I think that's been very interesting. Is like the home runs from 2024 that we have seen have been in tertiary markets, and so is that every time? Is that always going to be where we focus? No. But that's been the bigger win, I think, specifically with self storage, is like it's the combination of not just buying and do value add.
Hmm.
It's look for the right market, buy when you can from mom and pop, build when you can when you're not in a saturated market. And so like so many of like as a passive investor, that's why it makes sense to invest in fund structures more, I think, for a lot of these. Because people I know the temptation so many of us have had to be like, oh, I want that one screaming deal. It's like, well, if it's an $800,000 self storage facility and I'm a passive investor, there may not even be a business case to syndicate that.
Yeah. Yeah.
The numbers just aren't big enough. So to get access to it, I found it's better off to just invest in a larger fund structure for my purposes as a passive
Okay.
investor into a storage fund.
Do you make any investments that aren't real estate based?
Yeah,
Um,
I've made some too. I mean, there's alternative investments, crypto stuff.
okay.
I've bought some precious metals. Yeah.
Okay, that's interesting. I am always on the lookout for non-correlated strategies for passive income, and that might be private credit, it might be. I came across a group here recently that is experienced in purchasing airline equipment and renting it back to airlines, and they make a
Oh,
spread
that's
doing that.
cool.
So it was really interesting. We're going to be interviewing them soon, and I'm interested to hear more about that model. But there are a lot of interesting models out there. People that are buying, credit card debt and renegotiating it for needy families, or things like that. There's a lot of creative ways to really get into alternative investing strategies, and real estate has kind of been the bread and butter of this club for a long time, and a lot of the people that we talk to as well, because let's face it, real estate is the oldest asset class there is, a place
Right.
to live. um,
Truly. Yeah. Well,
it
and
is. It's as old as time.
and to
Uh,
your point about other asset classes and alternatives, like I have been, gosh, I don't know about you, Daniel, but I've been approached, I feel like, by so many of a couple particular asset classes recently, and I'm passing no judgment on any of them when I mention them. By the way, I don't know them well enough, but like you see, like oil and gas floating around, you see like merchant cash advances, like just other financial instruments that are out there, and these are ones that can produce cash flow, provide many of the wonderful passive tax losses that I have come to appreciate when I file taxes every year.
mhm.
But a key learning that I have gotten from this journey thus far has been like, stick with what I know.
Oh,
And
yeah.
gosh, talk about like a timeless learning that occasionally I need to get like a portfolio kick in the teeth reminder, figuratively, to tell me just stick to what you know.
Mhm,
But I think that what we have focused on is like finding great teams, and like how do we truly define with a framework like what is a great team? Like
mhm,
even if it is whether it's a storage operator or whether it's maybe we're looking at like oil and gas, and we I did look through a bunch of operators on that recently. We look at like the track record, the approach, the team, communications, and values. And there's a big nerdy spreadsheet with 70 plus rows on it that has vetting criteria beneath each of those. But like that is where I spend such a massive amount of my time, is just trying to get my head around like, okay, there's no shortage of like beautiful investment summaries that are out there.
yeah.
But how do we ensure that the team is truly up for the task? Because it's been very, very illuminating for them the last 2 years, like what it means to be up for the task. Because business plans are one thing, but people adjusting to the fastest interest rate spikes within 40 years is another thing.
Mhm, mhm. Tell us a little bit about your investment club.
Yeah, so we actually started this just as organic, our own portfolio building. And I don't know about similar to you and your journey with Intel, Daniel, but it started out very similarly. I was working in tech companies, leading operations groups. People said, "What are you putting your money in?" I said,
Mhm,
"Well, I can tell you, but I mean, I get on a plane, I nerd out on this stuff, and ultimately that showed that there was a big need for education. There's a big need for more hands-on due diligence. And so what we do is we go out and we find those great teams, we find great deals, and then I put my own money in with them once we've done our diligence and nerd out on it as hard as possible. And then we do that just a handful of times a year. It's been a very like slow transactional last couple of years because of the interest rates. And so we're not going to just pounce on a deal because there happens to be a lot filling up someone's inbox. Like we want to work on the great stuff. We want to invest with
mhm.
great teams. And so yeah, well, we did one single asset deal last year. I think we're going to see an uptick this year. We're going to have, I think, probably two funds and maybe 1 to 2 single asset deals coming this year, and a private credit fund as well.
Okay, okay. How did you, who did you invite to your first deal? Was it just friends and or not to your first deal, to the first club invites? Was it just friends and family, or did you grow it through your tech network, or
Yeah, I don't know about you, but like it was really just me embarrassing myself trying to be like, hey, I know you're at like going back to the conversations I would have with these coworkers, be like, hey, you asked for more detail. This is what we're investing in next.
very
Is
cool.
this something I can answer any questions on for you? But in reality, what I did was very nerdy. This was a full-on business exercise.
Mhm,
We wanted to do this right from the start, and so my brilliant second half, Jennifer, she is the co-founder of our group, and the COO, and we decided to put together a rigorous interview template. And I went out and I actually just talked to 50 folks in my network that I actually didn't know that well. Like we're talking folks that met who we thought were going to be the folks we're trying to serve. And typically within tech, maybe 5 to 8 years, et cetera. Folks that are doing great, dual income families that many FANG companies, of course.
mhm,
And I just interviewed them without any deal or pitch or anything like that in mind to understand questions like, what's your relationship with money?
Hmm.
You know, how often do you track and look at your portfolio? How do you do that? Do you use software to do that? Do you just nerd out on Excel? Do you DIY? And so I went through that exercise with 50 people, recorded the conversations, pulled out the insights. It was fun. It was a ton of work, and that really informed, oh, here's how we want to go out and build relationships and educate folks, And so that was the first way of getting to know people. And it was a lot slower, I think, than a lot of people folks who want to go build a club or build relationships like this. When they ask me, what should I go do? And I tell them that, and their heart tends to sink because they're like, wow, that sounds like a lot of work. And I'm like, yes, correct.
It is a lot of work.
It is
Yes.
a lot of work, but it's work that I'm passionate about, as are you.
I got to ask now, software or Excel?
Oh, Excel.
Okay. I was going to say it's got to be Excel.
Yeah, I
Um,
mean, I don't know if you have a good piece of software that you're aware of that can.
no, I am cursed with being a software engineer, and so I tend to spend a little too much time writing my own. But
Oh,
I
that's
like
awesome.
Excel, and I spend a lot of time in Excel and frankly Google Sheets too. I like quite a bit. Um,
I
but
think,
yeah,
yeah, in hindsight, I mean, I haven't done a line of code since high school, and then I became one of those business people. So I am stuck with Excel and Google Sheets these days. I won't be
yeah.
creating any software for myself anytime soon.
Well, I found that if you just go in deep enough, you can pretty much build anything you need to in Excel and Google Sheets. And so it's, when people say they need to go spend, several $1,000s on a piece of software, I always have a bit of reservation in my mind about that. Um,
That makes sense.
anyway, yeah, I like a straight up spreadsheet most of the time. All right. Anything else that you would like to leave us with here before I ask the final surprise question?
Oh, well, I think what's been insightful from the last year or so, since volatility has reared its head in the market, I mean, maybe 2 years now, um, is folks are feeling like disoriented. I,
Hmm.
I think a lot of LPs are feeling disoriented and
Yeah.
unsure. And what I always come back to, as at least as an LP myself, is asking like, what's the goal for the money? It's like a fundamental basic question, but I think even, 10 deals in, 15 deals in, 20 deals in and beyond, I still have to force myself to sit there and say, okay, am I allocating this 100K, this 50K to generate an income? Or is this something that I'm trying to get growth out of? And so, as
Mhm.
basic as that sounds, I come back to that before I go further down the decision tree and start saying, well, gee, is that cap rate in line with what I think it should be for that particular market subset? Like fundamentals first. And so I
Mhm.
just wanted to encourage folks to come back to basics on that, because our lizard brain kicks on very quickly when we see a beautiful PDF that has a very sexy looking, projected return, and we kind of lose all logic quickly.
Agreed. All right. And for the last question, do you have a book you could recommend to the Alternative Investing Club? Something, it doesn't necessarily have to be financially related, it could be anything. But if you do have a financially related one that you'd like to talk about, that'd be great too.
Yeah, I mean the most impactful book for me personally, Daniel, has been one by Greg McCune called Essentialism. I love that book.
I've not
That
heard of it.
basically, yeah, it really helps arm you with the ways to say no in service of, with your social graces intact, in service of focusing on the right priorities in your day. And I come back to like, well, I read that book when I was still in tech. A couple young kids, we were raising dual income household. Just I was working 80 hours a week in office in trying to also serve the members of our investing club. So I needed more time, and I was like,
Yeah.
that book came at just the right time. So I could say to that coworker, you know what, I'm sorry, I can't get that coffee today. Or I can't go to that happy hour, or I need to, I just got to focus on the right priorities, but not feel like a total
This
jerk for
this
saying no.
sounds like a book that I should read.
It's hard to
It's
say no.
it is $16 on Amazon right now.
Oh, it's worth it. I've gone through it 3 times, man. It's worth it.
All right, I'm ordering it. Well, Spencer, thank you for being on the Alternative Investing Club show, and I think we definitely like to bring you in as a Friday speaker. So I'm
Oh, thank you.
looking forward to having you there, and Happy New Year.
Yeah, happy New Year to you too. Thank you so much for having me on, Daniel. This has been awesome.
All right, see you all later, investors.